Hey, good morning, everybody. It's Chris von Lindenberg. I'm here with my colleagues, Justin Lynham and Vince Carbonero. And we're coming to you today. We're doing a team coffee talk. This is another little episode. And I'm going to put a shameless plug in for Tuesday, the 18th at 12 noon. We're going to have a lunch and learn coming up. So if today and if some of our videos leave you hungry for a little bit more information, make sure you look in your email about Tuesday on the 18th, 12 noon. We're going to do a lunch and learn. We've got a special guest speaker and super excited for that. My favorite quote of the week from client conversations and pertaining to these videos is, Chris, your videos bring me calm when markets make me nervous. That is the quote of the week. I won't tell you who said it, but my favorite quote of the week. So today, for our guests joining us, today we're actually going to go through something called the ICA Guide. It stands for the Investment Company of America, one of the longest standing mutual fund companies in the business, and a mutual fund company, frankly, that we use in many portfolios as a cornerstone of the investments is a company called the American Funds, also known as Capital Group. And they have a really deep research bench. But one of the exciting things is that they date back to the early 1930s. And so their oldest, longest standing mutual fund is one that we're going to explore today. And we're going to talk about it, not in any way as a solicitation. We're not asking for you to invest more. We're not asking or suggesting that you need to invest in it. This is just purely for educational and informational purposes only. And if you're wondering, many of you will have this already in your portfolio. And if you're curious, you can certainly connect with us directly one-on-one about that. So it's not an endorsement. It's not a solicitation. It's an example and a reminder that investing does in fact involve risk, and returns are not guarantees, but it is just a historical perspective that we're going to look at. So this is going to be available to you as viewers. It's going to be available in a PDF format through the email that we sent this communication out. And we'll also make sure you got a link to the stats update for current performance information. So without any further delay, let us jump in to the ICA Guide. And I'm going to go ahead and first point out that Justin and I are wearing almost identical sport coats today. So for those of you who are wondering, it happens from time to time. And let's see if we can zoom this thing in. So this has a track record of just shy of 90 years. And I'm going to start with a little reflection on inflation. Hey, Vince, why don't you take us away a little bit here? When we went through this guide, what did this stand out in your head? What jumped out to you?
Well, the importance of staying invested and avoiding simply stockpiling cash, because as you can see here in the guide, it shows you the steep increases of prices due to inflation on very common household items, such as the postage stamp, a loaf of bread. Look at the average price of an automobile now at $47,243, and the average cost of a single family home. In the beginning, we had a $5,972 home, and now we're up at average price of a $353,000 home. So it's important to not just park your money in cash, but save and invest properly so that you can keep up with inflation and stay ahead of these price increases.
Absolutely. You know, what's kind of interesting is just seeing since 1980, I was born in 79, but just seeing since 1980, how prices in many cases have tripled or more, depending on the item here. I think my folks may have paid something to the tune of around, maybe it was $40,000 or $60,000, actually, might be close to this example, back around that time frame, late 70s. And interest rates, man, where were interest rates at the time? And I'm not trying to jump ahead, but interest rates were sky high, weren't they?
Yeah.
Pretty ridiculous. Pretty ridiculous. So I'm going to go ahead and cruise ahead here real quick and hit on a couple other points. When we look at asset classes, Justin, you look at historical 50-year trends here. What do we notice about cash and inflation, and what's different maybe in today's world compared to what we've seen over a long period of time?
Well, inflation today is just absolutely through the roof compared to where it was, somewhere between 8 and 9% over the course of the last 10 months. Historical average, just north of 3%. So today it's costing us more and more to live than it was just last year.
Yeah. In fact, if you look at performance on pretty much any asset class, whether stocks, bonds, or cash over the past year, inflation's kicked all of their butts. And we're all in that together. We're all experiencing the effects of that. But this was an eye opener to me as well, in that, over the long run, if your goal is to manage longevity and inflation risks, then really stocks and bonds were perhaps a better tool, if you will, to use over that period of time than just putting the money in the bank. right? Because the bank barely outpaced it. Now, Vince, are we earning anywhere near to 4.4% right now in the banks that you've seen?
No, no.
Nowhere near. And, it's a reminder, though, that we've gone through periods of time where we've seen rates of return that have been in that neighborhood on cash accounts. And with the Fed increasing rates, we may see that again, but it still doesn't make it a good long-term investment to sit on a lot of cash. I'm going to go ahead and zoom out here and scroll forward a bit more. Now, in this guide, I'm going to moderate this piece real quick. In this guide, they actually talk about two different families that were preparing for and entering retirement. And, from a financial planning perspective, we can view historically, treasuries, government bonds as sort of some risk-free assets. And in history, they've paid out higher rates of return, which allowed investors to preserve principal and draw income and still have their principal left over at the end. That's pretty cool. However, interest rates in this example, they started back around 5.74% per year, but they ultimately finished in 2021 at around 1.94. That is a drastic difference in income stream. So somebody who did use that strategy 20 years ago, they would find themselves subject to reinvestment risk that would be pretty painful. I'm going to go ahead and cruise ahead and use an example. So a different example is saying, well, what if we had utilized an investment such as this particular well-diversified mutual fund? And this family put the same original investment in. They took a slightly smaller withdrawal over the period, but ended up with almost double the remainder interest at the end. They had almost doubled their money, a little more than doubled actually, but had almost doubled. And the other more interesting thing is while they started drawing less income, they actually ended up increasing income over time. And this example was showing, in essence, that they were pulling, we want to say it was like 5% per year, 4% of their 500,000 investment, and then they grew it by 3% per year. I'm going to keep cruising ahead. What investors own? Just, I'm going to turn this over to you in a second, but what I'd like to paint a picture of for a moment is sometimes we stumble into folks that have very concentrated stock positions, and not uncommon do we see that they've got a big concentration in their own employer's company stock. And we've also bumped in more recent times to investors that have taken a hold of very speculative investments that we might commonly think of as crypto, as an example. When you look at how this is diversified, if you think about $10,000 invested and you look at some of these companies, are these small names? Are these big names? Like, what's your outlook on this?
No, certainly. I've always jokingly said, not mom and pop type shops. We're talking about large companies that have time, tenure in the market, large asset pools, companies that are worthy of investing in for the long haul. And I think that's what, American funds in general has done that very well, right?
Absolutely. And, while certain fads may come and go, and while certain companies, may falter, when you look at how well diversified some of the investment programs are that we use, this is just one mutual fund of many that we would find in a traditional portfolio. But you see that the money is very well diversified. And a lot of these names have been around for a long, long time and probably not going anywhere. Many of them are likely to weather the storm, regardless of what we throw at it. I'm going to cruise ahead here for a moment. Hey, Vince, we're going to have a little fun here real quick. I know that you may have already looked ahead, but I trust that maybe you didn't write down the answer here. Vince, if you could have invested in any of these 5 companies, $1,000, right? If you could pick 5, and you did it 88 years ago, I'm just curious, just throw a couple names out there. Which ones do you think would have been a good performer for your portfolio if you could go back 88 years in history, way before you were born?
Sure. Well, Apple wasn't there at the time, but Apple jumps out at me here. Coca-Cola, Disney, Microsoft. And how about Salesforce?
At Salesforce. Yeah. So it's neat that replaced ExxonMobil on the list. So here's what's really wild is that if we go ahead, they put together an example of what the ending value of that $1,000 investment would have been 88 years later. So using those predecessor companies and 88 years later, where would they have come out? Hey, Vince, what's your take on this? You didn't come out number one.
No, even if I got to individually choose my 5 favorites and went ahead with that strategy, I still would not have come out ahead of the ICA's diversified portfolio.
Yeah. So we're not, again, advocating to say, hey, this is an investment that you need to go out and purchase or invest more money in. But what we're doing is providing you with an example of where active management and steering the investment ship over time could lead to a potentially better result than just cherry picking, even in hindsight, right? With the knowledge we have today, going back, man, if woulda, shoulda, coulda, if we could have invested in some of these companies over this long period of time, a diversified investment portfolio can actually outperform. And in this example, they did. They've got a great track record. All right. I'm going to cruise ahead here real quick. And there are lots of reasons when, history hits us and there's reasons not to invest, but I'm going to actually show this. I'm going to show you a mountain chart. But first, Vince, thank you for the reminder that you had given me before. What does this mean, this chart? When we were talking about the mountain chart, what's the significance of this image here?
So when you're looking at the chart on the paper, you see that it's very small on the page. And in looking closely at what it tells you is that this climb up the mountain isn't drawn to scale, obviously, because we'd never be able to see it here on the screen. If you look at the dark blue area of the chart, that's the growth of your investment without reinvesting the dividends that are paid. And the light blue area shows the gap between what you'd earn if the dividends weren't reinvested and what you would have if they were in fact reinvested. And what it explains is if it were done to scale, this chart would be, well, it sounds silly, but off the chart, and it would be taller than a skyscraper or the Statue of Liberty.
Yeah, pretty crazy. So the initial investment back here was $10,000 in this example. And I realized that was a pretty good amount of money back in 1934, but not much unlike some of our investors may have today. And as we go through this mountain chart, Justin, what are all of these years that are listed? What are these events and what's the significance of some of these events?
Obviously this is for illustrative purposes, but this is a great example of maybe reasons why we would have deferred not investing in the market, right?
Yeah.
It represented some sort of fear as to, why being in the market at that time would not have been a good idea.
Yeah. So like headlines that grabbed our attention that year that would be cause for pause. Like, gee, I don't know if I want to invest right now because there's some bad news out there. Oh my gosh, energy crisis. Let's see. That was 1977. I remember seeing pictures of that in the textbooks with the cars lined up around the corner. But when we say energy crisis, that doesn't ring a bell or strike a chord with anyone, I'm guessing right now, right? When we're thinking about sky high energy prices.
Well, I think too, for folks of our age or demographic, something that occurred in the 1950s, 60s, and maybe early 70s isn't necessarily relevant to them. But if you go further down the chart, you can see events that we've lived through,
Yeah.
right? Like we've personally experienced, and I think that they draw, I think they strike home a little better than maybe some other stuff we see.
I'm going to zoom in real quick. Worst recession in 40 years. That was back in 1982. That was the headline. And Vince, thank you already for telling us that these lines means that it's not drawn to scale here, but worst recession in 40 years. Oh my gosh. Well, I'm going to zoom out. Has the market recovered? Have we grown beyond that? Holy moly.
Yeah, absolutely.
Absolutely, right? Now, what about for some of our younger investors, maybe those that are in their late 30s or early 30s, and they're just getting used to investing and they're seeing things? Well, let's talk about some bad news more recently that maybe we have forgotten about. Actually, I'm going to go back right around Y2K.
Mm.
Remember the world was going to come to an end?
Yeah.
Every alarm clock in the world would stop working, microwaves, cards stop running.
I actually worked for a person at the time who was stockpiling barrels of gasoline in his garage.
Really?
Yeah, absolutely. And he was a heavy smoker, so it was always a near disaster waiting to happen.
All right. Well, then we've got the internet bubble burst, right? All those stocks. I remember as a kid, we grew up and I grew up boating, and every weekend we went to our floating trailer park, if you will, on the water. And I remember folks talking, my parents' friends talking about, man, if things keep going, I'm gonna be able to retire. And I remember after the internet bubble burst, we're like, oh man, I'm gonna have to keep working a little longer. And then we have 9/11. How could we forget? God bless those that lost their lives. The corporate accounting scandals, Enron, WorldCom, Bernie Ebers, we remember those, right? Oil prices soar. That's kind of interesting. I don't know if we remember that. Let's see, what year was that? That was 2004 when that happened. Hurricanes. Oh, gee, we just had one of those. Dow Jones topped 12,000 for the first time. Now, I'm going to pause on this one real quick. I want to go backwards because I remember Dow Jones topped 4,000, then 5,000, and it was deemed to be too high. I'm going to scroll back. There was another time that the Dow came up. I want to say it topped 300, and somebody said, hey, it's too high as well. Oh, here it was. Dow topped 300. It was deemed to be too high back in 1954. I guess we're a little beyond that now. But let's keep cruising on some of these because these are kind of interesting. So there was the Dow subprime credit crisis. Anybody remember that? Vince, Justin?
Yeah. A lot of folks underwater on their mortgages for sure.
A lot of folks underwater.
Mortgages to people who probably shouldn't have had them. And
I remember 105% financing where you signed your name on the bottom line, you got a set of keys, and you got a check at closing, and have a nice day. See you later. What could go wrong with that? US recession, unemployment top 10%. We had that oil spill, sovereign debt, the fiscal cliff. I forgot about that one. Let's zoom into some of these a little more closely in recent years, because some of these, as time marches forward, we lose sight of them. Ooh, Greek debt crisis. Remember that? I remember those headlines.
Yeah, they're standing at ATM machines trying to pull money out.
Yeah, the COVID pandemic. Man, what do we remember about that? What happened in Q1? Markets, Vince, they took a tumble, right?
Yeah, absolutely.
And then
Totally unprecedented.
Yeah, I remember before people realized how far accounts had fallen and gotten their statements, it started rallying in early April and throughout Q2, and then we hit record highs again. And here we are back at inflation rates surge around the world, and that did show up in other places on this mountain chart. Hey Vince, walk us through. So ICA with dividends reinvested. What was the initial investment again on this mountain chart?
$10,000.
$10,000. And the average return was 12.2%. And if we didn't reinvest the dividends, look at how the amount of final value dropped.
Yeah, it's remarkable.
220 million. Now, I know it'd be tough for most of us tuning in to invest for the next 88 years. I think that might be an out-of-body experience. But just seeing the difference that reinvestment of interest in dividends makes. And Justin, let me ask from your perspective, even if a client did nothing other than hold on to their investment, what's one of the benefits to doing that each year? What gets reinvested?
Oh, the dividends, the interest, the cap gains, they all get reinvested. And compound interest, right?
And that can make a really big difference on the long run. And oh, by the way, for those that are wondering at home, this mutual fund also had a track record during that time of outpacing the indexes, right? Because it was actively steering the ship. Didn't do it every year, but over the long run. I'm going to zoom out one more time here. And when we look at this overall mountain chart, those of you staring at home, you can see these little red dots at the bottom. Those are all negative years. There were 16 of them. And in some cases, there were 2 of them that were back to back. I don't know that that's what we're going to experience here, but look at the very next year. What do we see there? 2003 on the heels of 01 and 02, 26%.
It's fantastic.
Yeah, amazing amount of growth.
Almost.
What's interesting, Chris, is if you zoom back out, you can see that every year the old fear is replaced with a new fear, right?
Yeah.
Literally, every year an old fear is replaced with a new fear, but yet, as you can see, the market continues forward.
Right.
So I think it's a great representation of whether you choose to participate or not, the world's not going to stop for you, right? You can either stay on the sidelines and watch it happen, or you can get engaged and participate. And yeah, there's going to be some bumpy roads along the way, but this is a great illustration of the opportunity for growth if you choose to take advantage of it.
Absolutely. I'm also reminded by this chart does not show intra-year highs, nor does it show intra-year lows. And so therefore, when you think of it in that context, there are times where, we may have had a positive year back here with COVID-19. However, the realities are when that happened, we still ended up positive for the year, 14.5% on this particular fund, right? But it doesn't show that you actually were down quite a bit at the end of Q1. So, all right, we're going to wrap this up real quick. I like this. Louis the Loser. Vince, do you have any perspective on this chart, or you want me to take a run at it?
Yeah, no, I saw this and it was pretty impressive because Louis the Loser, he invested in the ICA on the worst days that one could invest every year when the share prices were the highest. And despite making those bad timing decisions, he still came out ahead on his investments, even though he was purchasing the shares at the worst possible time one could purchase them without dollar cost averaging over a period of monthly payments.
Right. So making investments on a worst day versus a best day scenario, at the end, Louis the Loser, still, if he acquired all of his shares on the worst day, still worked out just shy of 10% in this example. And this, by the way, is an F2 share class example. This is an example of a holding that we have in a lot of our investor portfolios that are managed accounts. And if he had done the worst, market low, the best time to put money in, he did best it by about 2%. We know that that makes a difference over the long run, but still over a 20-year period, Louis the Loser still did all right. I think he's still a winner in that example. All right. So I think that's really a way of buttoning it up, but a reminder that periods of time, you can have a number of periods that are 1 year or 3 years where there are negative periods in terms of return, but you can still see that overwhelmingly the number of positive periods increases the longer duration you look at. So it's a reminder that it's time in the market, not timing the market. So with that, I just want to say thank you, a big thank you for everyone for joining us today. It fills us with gratitude to know that you watch our videos, that you appreciate the insight and perspective that we provide. And again, a shameless plug, next Tuesday, we're going to have somebody from the Capital Group join us for a lunch and learn. And I believe that's going to take the place of our coffee talk next week. It's going to be Tuesday at noon, a live presentation. It will not be recorded. So please tune in and join us. We hope you will. So thank you all very much for being with us today.